Well, it is 12 p.m. Eastern Standard Time. Thank you so much for joining our webinar today. My name is Michael Mandarino, owner and agent of 123 Life Insurance. I've been in the insurance business since 2002, and we're so glad you're spending some time with us today on leverage life insurance. I have my team with me. They're going to be presenting today. We work with this case in particular is going to be for those who have a net worth of more than $10 million because you're going to be learning how we're using leverage. However, if you don't meet that criteria, and you like what we're showing you today, we do have some other options that you can definitely work with you with our team. So without further ado, let's go ahead and get started. Colin, welcome. You want to come off mute?
Thanks, Michael. Great to be here. Thanks all for joining. Appreciate you spending a little time for lunch here. We'll try to make this short and sweet. I think the biggest takeaway here is we hope to kind of tell you a little bit about what we're doing. And if there's further interest, we'd love to schedule a follow-up call, which I think Michael just threw in the chat for all of us. That'd be really the goal here. This is a very customized strategy. We work on a very individualized basis. So we're really excited to have those individual conversations. But of course, we're excited here to talk to you about Leverage Life, give you a little sample, and we can kind of go from there. So I'll introduce myself briefly. My name is Colin Steinberg. I've been assisting high net worth executives and families for a little over a decade now. I specifically work around tax planning, keeping more of what you already earn. I think that's really the key to wealth accumulation. And because of that, I've been very heavily involved in different tax efficient strategies, including life insurance. Leverage life insurance is what we're going to be talking about today. And I think it's a great strategy that we've been personally working on for over, over a decade, myself, probably about 9, 10 years now. Jordan, I'll let you go ahead and talk about how you kind of help out the team as well.
Sure. Thanks, Colin. So I started off my career as a tax and estate planning attorney for one of the large Detroit area law firms, about 90 or so attorneys, after getting a law degree from Michigan and a master's in tax from NYU. And during my 11 years at the law firm, became an equity partner and built up a practice area that focused on using life insurance as an asset class to drive wealth transfer, business succession, and retirement planning strategies that we would implement for our clients. It ended up taking over my entire practice, left the law firm in 2007. And Colin and I have been working together for a number of years where my primary role is to help understand what objectives clients are looking to achieve, and then design strategies and structures to most efficiently achieve those objectives.
Thanks,
Thanks,
Jordan.
Jordan. And Jordan, thank you for your time as well. And for those that are just joining us, one of the housekeeping notes is we will be taking questions and answers afterwards. So you can put your questions in the Q&A section at the bottom, or there's also ability if you have questions for any of the panelists personally, you can also type that into the chat as that is another function. But so glad you guys are here today. Colin, take it away.
Yeah, thanks. All right, so I'd like to start by just telling you guys a little bit about us, our firm. So we are all under the same roof of Schechter. We have been in business for 85 plus years. So we've been doing the life insurance business forever. Third generation, we have probably close to 5,000 policies. Now we have 11.4 billion in death benefit and then 1 billion in cash value. We're a pretty large firm out of Detroit, but we still maintain a very boutique type structure. The only way for this to work is really you have to have a village. So when we're talking about leverage life, these are all the folks who are involved with individual policies. We have banking teams, we have service teams, we have estate planners, we have tax attorneys, we have service providers, we have an underwriting team. These are all folks that it takes to make this happen. Now, there's many groups out there that work in the leverage life space in different levels. There's only a handful of brokers specifically that are able to do the leveraged life that we're talking about from a carrier standpoint. And it's necessary that you have a team built and a reputation, and that's exactly what we have. Um, so going into just before we get too deep, why we talk about life insurance and why we're using life insurance. So we really use life insurance as a tax wrapper. So life insurance has a lot of advantages that when you're paying with after tax dollars, the life insurance is going to grow tax free and can be taken out of the policy. Dollars can be taken out of the policy um, on a tax free basis as well. So we really have a ton of tax advantages when we're using life insurance. And that's specifically why we put a lot of our strategies into life insurance, because when we're trying to create positive tax results, life insurance is really the best vehicle out there. And it was designed exactly for this kind of structure. Typically, when we're using life insurance, we're really not designing it how you would typically think of life insurance, where you're trying to pay the least amount of premium for the most amount of death benefit. It's actually really the opposite. We're trying to stuff as much money as we can into these policies for the least amount of death benefit so we can really bring down the charges on a policy and really drive the tax advantages of life insurance. So we're going to talk about leveraged life today, but we're doing a lot of different things. So leveraged life is not our only feather in the cap. Really, our whole company is designed around using life insurance as an alternate asset class and the many different ways that we can use it to our clients' advantage. We have a couple different conventional and unconventional structures here, but we do many things, but leveraged life happens to be one of the things that we do likely the most and are really quite built for. So, little bit of a background. What is leveraged life? So, leveraged life has been around since '98. Essentially, there were some folks in the insurance industry that realized that insurance returns generally were outpacing interest rates. And if that, as long as that was the case, they said, well, why would we pay for insurance out of pocket when we can turn around and potentially borrow money from a bank and then invest in the life insurance? And then we would be getting some sort of kind of carried arbitrage for the insurance. So that's really kind of how the logic started. It's very similar to kind of owning a home, for instance. If many people can afford to buy a home with cash, but they don't because it really protects a lot of liquidity and things of that nature when you can use a bank. The only piece of this is, as Michael mentioned earlier, the banks that we work with are typically looking to work with 10 million plus individuals, and that's kind of liberal definition. But generally, they're looking for high net worth individuals that are borrowing a decent amount, and then they're willing to lend capital into an insurance policy. And really, what you're making up here is the arbitrage between what these insurance policies return and what the interest rates are. Currently, insurance policies are, I think, historically, a good example. They're returning 6.45%, and market rates, interest rates that we're seeing from banks right now are falling almost under 5. So at any point, there's always been kind of a carry with the interest rates and arbitrage of the insurance. But that's ultimately the strategy. We're borrowing money from a bank. They're paying the premiums on the insurance policy. We are in turn paying interest. And these are very safe policies. The lenders, the banks just honestly can't do enough of this business. They're giving 100% loan to value on the cash value of the policy, which is as good as any asset on the market. It's basically cash. There's a very low default risk because these policies have floors in place. The volatility is very much managed. So when we have market downturns, the policy is not losing half of its value. When we have market upswings, we're not hitting home runs. It's a very conservative type strategy, but as you'll see, there's some really good uses of it going forward. The last piece I just want to mention is we'll kind of go in a little bit, but there's many use cases for leveraged life insurance. I think we see a ton of it in estate and legacy planning, really trying to pass on assets to the next generation for tax efficient wealth accumulation, often for retirement income purposes. We use it a lot in executive and business strategies, using business assets, leveraging them and using them for owner benefits. And then again, for clients with projected net worth of 10 million.
And Colin, can you just stress the why banks like these types of policies as far as how the policy is being used as collateral and why this is something that we feel is even with the lower or higher interest rates could be a good opportunity?
Yeah, so there's really kind of two pieces to it. First, the cash value again, as I mentioned, the cash value on the life insurance, they're loaning 100% loan to value on that cash value, anywhere from 95 to 100. So they really see the cash value inside this life insurance policy as cash. So it's a very attractive asset for them. If you were to lend on a building, for instance, they might give you 40% on the value of that building because that building can really fluctuate with market downturns. You know, a real estate crash can put that building down 40%. We can't go below zero in any down year. Um, in addition, when banks are looking at these plans, they're definitely long-term strategies. So they're excited about having kind of the long-term lending. And they realize they're kind of building departments specifically for leveraged life. And they understand that the arbitrage needs to exist for these policies to work. So they have a lot of kind of skin in the game as well. They want to continue to get this business in the door. So they're very eager to provide the rates necessary to make the arbitrage work in all market conditions.
Thanks, Colin.
Yep. Um, I'm not going to go too detailed in this, but this slide will go around after the call here, just so you can kind of see. This is specifically for a estate type structure where you're owning the life insurance in a trust. It's probably good to own it in a trust, regardless whether you're using it for estate purposes or potentially retirement. But this is just so you can kind of see how the different types of structures work in tandem. Uh, so a little bit about our leveraged life numbers. So we've been doing this. Not only do we work with hundreds of clients, but we also work with hundreds of partners. That's financial advisors, CPAs, estate planning attorneys, other insurance professionals. As I mentioned, we're one of a few groups of brokers that all carriers will work with to do these premium financing arrangements. So we have a lot of partners who trust us and realize that we have the systems and resources built to service these types of policies. Average time, as long as we have, a lot of quick turnaround on collected documents and underwriting, about 12 weeks. I would say it's kind of a 50-50 split between clients doing this for accumulation, cash purposes, and death benefit. We've placed over 100 policies in the last 18 months, and our average premium size is about $850K. Okay, this is really where I wanted to kind of hone in on. And I think it's helpful to understand who uses leveraged life and why. So, a couple of quick examples. So, the first example is we had a 50-year-old couple who used financing to maximize retirement benefits. With about 125 million capital commitment, the program was expected to generate $475,000 per year of tax-free income. Essentially, they were paying about 125 million in interest, and because we use leverage, we generated significantly larger cash flows that they ultimately were able to take down the road. So all that arbitrage that happened by putting in that loan structure, they're getting not only the growth on top of the difference between the interest rate and the insurance returns, but the capital they committed. In comparison, if they were to just pay out of pocket and do the same type of insurance strategy, that number would be significantly less. So really great idea to think, hey, if I need assets for retirement and I'm looking for a really tax efficient way to do so, leverage could be a really good strategy to incorporate into either existing life insurance or new life insurance to produce benefits for retirement that come out tax free.
And to emphasize, and Colin, not to interrupt, but to
Yeah.
emphasize also that tax-free income, the reason that's able to do is you're actually taking a policy loan and the insurance carrier is using leverage of your life insurance as collateral. So you're not actually taking a withdrawal like you would as an investment. You are taking a loan, and that's how it can be a tax-free income strategy. And it's also in most states, it's protected from creditors as well.
Thanks, Michael.
Yeah, thanks so much.
Yeah. Um, the second example here, this is probably the most common example that we run into, where we kind of deal with these types of structures all the time. So I'll just say, in general, when people are transferring wealth, the most common suggestion that you will often see is that you own life insurance inside of an islet, which provides liquidity at the time of death, whenever that is. We can never predict that, but provides liquidity at the time of death and prevents any sort of fire sale of a business, fire sale of assets. Just a really big tool in the estate planning world, because there are plenty of horror stories of someone not having their estate in set up yet. Uh, and not being able to pay the taxes that come along with passing on estates to the next generation. So generally, when you're working with estate planners, you're working with insurance brokers, they're often talking about ways to fund an ILET. And that's specifically what we did here. So we had a 60-year-old.
And Colin, can you explain for those that don't know what an islet is, what the full term is?
Yeah, thanks, Michael. So an
Mhm.
ILET is an irrevocable life insurance trust. So this is a life insurance trust that we're going to fund for the benefit of the next generations to pay down estate taxes and effectively pass on a significant amount of wealth. We use an irrevocable life insurance trust because if it was revocable, it could be included in the estate. It would be included in the estate. So that's an irrevocable life insurance trust, which means it's outside of your estate. But as we can talk about at a later time, there is still some kind of levers and access that you can still have to those dollars. So in this example specifically, we had a 60-year-old who was looking for estate liquidity. He needed about 25 million to fund an ILET. He's going to have significant estate taxes when the business passed on to the next generation, in addition to the many dollars that he had outside of the business. So it was originally looking. He actually received a quote from another advisor that was going to cost him about 10 million to fund about a 25 million dollar whole life policy, where he was, essentially paying 10 million out of pocket. And at any point when he dies, he was going to get 25 million with a little bit of growth on that upside. We looked at that and we said, hey, is there a way that we can use premium financing? We did use premium financing. We lowered his upfront cost to about $1 million, and we increased his projected death benefit to about 44 million. Now, the additional death benefit is terrific, but I will tell you that the most excited that this individual got was that he was spending $1 million instead of $10 million. And the amount of growth that he could get on that $9 million by not putting in the life insurance was a real kind of sweetener for him. So projected death benefit is great. That'll be great for the next generation. But really, the preservation of liquidity is really what drove this strategy home for this individual. We have the third strategy. I'll just kind of high level this. If you are uninsurable, it doesn't necessarily mean that there are not opportunities. We often see uninsurable individuals doing this on their next generation. So they might have already done all of their estate planning or all the estate planning that they can do. And they've turned around and done leveraged life insurance on children within a trust, done it on the child's life. So it's probably a younger individual. And it really allows them to have a tax efficient asset that is going to grow throughout their lifetime, pass on to grandchildren, and can really be kind of a legacy dynasty like strategy. The last example is we had two people who owned a business. We often use leverage life in business. We have a corporate specialist who understands businesses, corporate balance sheets, and the different ways that we can use leverage within them. In this example, we had two partners who needed 50 million to cover a buy sell. They were starting a private equity fund, growing very fast. They were looking at some permanent options, which were costing them a lot of money. They had a much bigger desire to keep that money and continue investing in their fund, which was probably generating upwards of 20-40%. Not what this insurance is necessarily doing. We showed them how to use premium financing. I'm using premium financing and leveraged life. They're kind of interchangeable terms. But we showed them how to use leveraged life premium financing to spend the same amount on a permanent asset that not only, they could have done this with term, but now they have a permanent asset around the same economics that they're going to use for the buy sell during the business life, and then they're going to turn around and use for estate planning once they both retire. So lots of different ways to use this and lots of different ways that can be fungible, move it around, and portable to different needs and goals. I'm not going to go through this, but just so you can kind of see, this was the non-finance couple. and what they would be looking at from an outlay standpoint. If you're a 50-year-old couple, an outlay might be something around 6.6 million, 38 420 for 20 million at death benefit. This is just a general, hey, how much does it cost to, fund 20 million at death benefit if you're a 50-year-old couple? And then if we took the same amount of money, the same amount of death benefit that we're ultimately going after. This was around the 44 that I spoke about in the last example. But if you put 1.25 into an insurance policy, what can you really leverage that up to? And as you can see, we're much higher than the 20 million. We spent about a sixth of the out-of-pocket cash flow, and we got a much larger policy out of it. We have one more example that just kind of shows taking income out of the policy. Again, this just kind of relates to that some of those case studies that we were looking at. So as you
So,
can see, really,
hey, Colin, I'm sorry, just to go back, just to re-emphasize for the first option, if you go back to with
sure,
the premium they'd be putting in on their own is about $6 million. Is that correct? That's on the premium side on the left-hand side
that's
for the,
correct.
okay.
Yeah, for 20 million, if we're setting this up to say, hey, what's the least amount of money we can put in this thing for about 20 million of death benefit, you're looking at about a $6 million outlay over the course of lifetime. We could obviously structure this in a couple different ways, but that's about the expectation that should be understood for this amount of death benefit. And again, as you can see, by paying interest on a loan, having the bank pay these premiums instead, we've significantly reduced it. And again, I want to keep coming back to the idea of, it's very much like a house. When you mortgage your house, you do it for reasons because you're basically going to outpace the interest rates. That's exactly what we're doing here. We're not paying cash for a house because we don't have to, and we can do better with our money invested elsewhere and also get more leverage return.
And the other thing you're emphasizing is the death benefit. The death benefit in the first example was only $20 million. And you can see on the left-hand side, that death benefit is already 21 million. And of course, it keeps growing for as long as that policyholder is alive. So two very, very distinct differences as well. And of course, growth is not guaranteed. These are based off of hypotheticals. But you can see there, any growth is different than no growth.
Yeah. Thanks, Michael.
Mhm.
Okay, so next steps kind of, we'd really love to have kind of individual conversations with everyone, even if you think this might work, if you want to just explore this a little bit deeper. We want to look at this through a couple different ways. We want to understand your taxation. We want to understand what kind of liquidity you have. We want to understand your risk tolerance. It's obviously we talked about net worth, but really we'd kind of go into an interview process where we understand the family dynamics, if you have estate planning or retirement goals. And then also we work with a number of banks, but we also want to understand your banking relationships because there may be advantages to using current banking relationships rather than going to market with the ones that we are finding. Speaking of banks, major banks are the folks that we're working with. We're really only working with large banks with limited credit risk. So U.S. Bank, BMO, BNY, Wells Fargo, Wintrust, Northern Trust, JP Morgan. These are all major banks that have been around for a long time. So we have a lot of confidence in these lending relationships that we've established. This slide here, again, I won't go through it, but too deeply. But I want everyone to kind of understand, hey, if you're asking, hey, how does this leverage exist? And where does it exist across many ups and down years? So I think really what I want everyone to kind of pay attention to is the spread column. So in some years, you're going to have negative spreads where our interest rate has outpaced our return. And in some years, you're going to have significant upside performance where our performance inside the policies has significantly exceeded our interest rate returns. Overall, an average since 2004, we've seen a 3.6% return on that spread. So that spread is really what's driving this strategy, and you're seeing a lot of the growth there. General question, I know people probably are asking about rates. SOFR, we do it, interest rates are based on SOFR, about 3.66% right now. We're a little bit under, I'm excited to say we're a little bit under 5% today, but it's good to kind of expect an all-in rate of around 5%. The last piece that I want to just touch on is interest rate is obviously another variable when we're looking at these types of policies. We are very cognizant of the fact that we can lock in interest rates. If there's ever a concern of, hey, what happens if interest rates rise in this program and suddenly this doesn't, I don't necessarily buy into the historical precedent, but I do believe, the market's going to continue to perform. A really good thing to consider is, hey, what if we locked in our interest rates, took the interest rate uncertainty out of the equation? And here are just some examples of what locking in interest rate looks like. That's all. Wanted to keep this short and sweet. I guess we can open up to questions now. But I hope this was informative. Again, this is really just kind of meant as a teaser. We'd love to have individual conversations with you. I think that's really where you'll see the magic happen. Everything we do is extremely customized, so we can't really show on a full webinar something that applies to you. But I'm sure when we sit down, spend a little bit of time looking at this, you'll find that there's a lot of things that are relatable, and you really get an understanding of how this program works. So I'll leave it at that. And
So, Colin, a
question.
couple of things that come up as far as with questions. Typically when it comes to, can you kind of walk through what the next steps are as far as how we're going to be working with them?
Sure. Yeah. Again, really the first step of any sort of arrangement is an interview. So you would sit down with myself and Michael. Jordan might be on as well if we're talking about specific estate type structures. We're going to interview you. We're going to talk a little bit about your goals. We're going to talk a little bit about your family dynamics, talk about your risk tolerance, understand and kind of gauge your knowledge on leverage, understand your knowledge on insurance, and really kind of do a little bit of education, a little bit of interview. After that, we can go into kind of putting out models that make sense for you. And then from there, if there's interest and we want to continue moving forward, then we're looking at things like medical underwriting. So you have to be medically underwritten for these strategies. Financial underwriting, which is pretty straightforward with a bank, and then policy implementation.
Perfect. Thanks, Colin. And
Yeah.
Colin and I will be doing, and if we need to include Jordan and as far as the team on joint meetings to really kind of figure out what those next steps are. The big thing with underwriting is to make sure that if you're not insurable, is there someone in your family tree that can be used, as you said, if someone's old enough that they're not insurable as well. And then for those who don't meet the criteria for the $10 million, there are some other companies. Again, it's just what we briefed on today is as far as the lending. It's not always available for those that are under there. So we did put a link into the chat. Also, right now, we'd like to answer some questions. You will be getting follow-up emails, especially the recording once we get it through YouTube. Colin, if you want to go ahead and just, keep that slide up, that'd be perfect. But
Yeah.
we
Yep.
will be answering, obviously, questions now, but then you will be getting follow-ups. We do not like to spam folks. So, if you're not interested in receiving further follow-up phone calls, just please hit subscribe or unsubscribe, and we'll gladly be able to take there. But for those that don't, that are on listening only, my personal cell phone number is 813-807-0391. And again, Colin and I will be working closely together. So, and Victoria, I saw that you had a question. If you want, we can go forth. The first question we had, Colin, is please describe a deal gone bad and why. If you want to kind of
Yeah.
rephrase that.
Yeah, that's a great question. So we specifically deal with a lot of deals gone bad, but they're not ours. And that's because we've kind of gotten ahead of a lot of these bad deals. I would say specifically how deals have gone bad that we see most often is overly complex life insurance policies as the underlying piece. So we keep things pretty darn plain vanilla, where it's like I like to think of it like the TV remote that has a million buttons and then it never works. That's kind of how we think about life insurance. We don't want a policy with a million buttons because all these buttons can be pulled, and sometimes if it's bright and shiny, it's not really what what you think it is once you get up close. So we have a whole policy analytics team that's really back testing all of these policies and understanding what works, what doesn't. What we see, and often what we get called in to do rescue cases, because we have an advisor out there who basically sold a policy, put them in some flashy return bucket that told them they were going to, earn a really big percentage that was just not realistic. Told them they had very little outlay required of them. And it turns out the policy didn't perform and the advisor disappeared. And then they come to us and, fortunately we can do some things to rescue the policy, but they're really kind of underwater. So I'd say the most important thing that when you're looking at this is a deal's going to go, whether or not a deal goes bad, you need a team that's going to service this forever. That's what we do. That's what we're built to do. We have a servicing team of 10 members who is constantly monitoring and looking at these policies on a quarterly and annual basis. You don't want an advisor that's going to disappear. And most importantly, you want to have your kind of finger on the pulse of all the different types of policies and the different indexes and make sure you're in the right bucket when you're looking at this.
Yeah, thanks for that, Colin. Colin, we also have another question that I think I can also answer that says, for real estate, can you 1031 into a life insurance policy?
Go for it, Michael.
Yeah, so with the 1031 exchange, what you're referring to is the IRS code 1031, where you can buy into a like-kind property. So in most cases, you cannot do that. However, our team, we do work with ideas. If you're looking to, exit the real estate space and want to put those policies to work, we definitely have programs available in the 1031 space. However, as far as the IRS code allows you to do a like kind, it's actually with insurance or annuities. So if you have an annuity that you want to roll over, or you have a older life insurance policy, you can do an IRS code 1035 exchange into that newer policy. And we do that all the time. I know someone asked a question about variable universal life. I used to be a big proponent of those until a newer program came out with the index universal life. And that's what Colin was explaining is, we have a zero floor. And we found, when you don't have that floor, and you see a major market downturn, which we're going to always see, whether that cycle is a 6-year cycle or a 12-year cycle, when that market goes down, that's where, the deal gone bad, to answer Joe's question earlier, is it could be in some of those older policies that did not have that floor. So Ben, I hope that answers your question, as far as, with 1031 numbers. However, we can, as we're dealing with taxes, we can try to offset what you're going to be paying in the real estate using some of the other programs that our team and even getting with Jordan that can work on together as well.
And I'll just reiterate on that VUL piece. Banks will not lend on VULs. So it's not even a decision of ours. It's banks specifically. They will not lend on VULs because they want that floor in place. If they're going to give you 100% loan to value and the cash value of the life insurance, they want that certainty that the floor is in place, and that makes it a conservative asset for them to invest in. If you have that variable where you have the market fluctuations and variability, they don't want to deal with that business because there's just too much risk for them to get involved.
Perfect. Thank you. And Victoria, I see that I know we've been texting back and forth. I'm going to put a function there if you want to ask your question. I know you weren't able to hear everything. We will be sending out a recording, and everyone will get a copy of that recording. So Victoria, if you want to come off mute, we can, if you have a specific question. If anyone else has a question, go ahead and raise your hand or ask it in the Q&A section as well. So Victoria, if you're still on there, if you would like to answer or ask your question, if not, we'll definitely, I know we're going to do a follow-up with you as well. Jordan, did you have anything else that you wanted to add?
So the one thing I would add in response to the description of the deal gone bad, on top of what Colin described, which I think is probably one of the primary reasons if people get the wrong product or they get talked into putting the money in the wrong index. And by that, I mean that, a lot of the products out there, even index products, have what are described as volatility controlled indices rather than what we would recommend, which is the straight S&P. Those that just have not performed. The other thing that causes deals to go bad is when they're not funded the way they're designed. where when we illustrate a premium finance case, leveraged life case, where you're putting in, say, 7 premiums, and a client decides after year 2, gosh, interest rates are up. Maybe I just won't fund the year 3 premium or the year 4 premium. If you don't implement the program the way it's designed, it's not going to perform the way that it was projected. And so I think it's really critical if we want to have confidence that we're going to get the results that we've illustrated, we've got to fund the program the way we've designed it. And so that's another problem that we see, and we get a number of cases brought to us that other people had put in force where either they put the cash into a bad index or they didn't fund it the way it was originally designed. And people have said, well, can you rescue it? And in some cases we can, but that's where we see the problems.
Yeah, thank you, Jordan. And being in the insurance industry for so many years, that is the biggest problem is an underfunded insurance policy. And it's sad, but I've talked to clients that are in their 80s, and I asked the question, and I wasn't necessarily the writing agent. How long did you tell your initial agent you were going to live? I didn't think I'd live past 75. So if the policy is not funded correctly, that's where these policies can come through. So when you work with a team like Colin and I and Jordan and our group, we make sure that these will be funded based off of the requirements. Because again, we're flipping the script when it comes to life insurance. We're not paying the cheapest premium for the biggest death benefit. We're paying for the lowest death benefit with the highest premium. So you have more of your money actually working for you, or in this case, more of the bank's money working for you inside the policy. Again, for those that are still on the call, we really appreciate that. If you have any questions, please either raise your hand or you can type it in either in the chat or in the Q&A section. Colin, is there any lasting thoughts that you want to have for everybody?
No, I'm looking forward to the individual conversations. I think, as you'll find, we are really the tip of the iceberg here, the three of us. But we have a very, very deep team behind us where you'll see we have experts in every facet of the life insurance and leverage space servicing. That's what really makes our team work and helps us avoid policies that go bad. So excited to introduce you to the rest of the team. I appreciate everyone's time today.
Yeah, and I thank you everyone as well. Again, being a part of a team is so important because the deal gone bad is when you start a policy with an agent that is no longer going to be around and they don't have a team behind them. So, for me, partnering with Colin and his staff is so important because, hopefully, especially for someone that's younger than me, this policy needs to last not only our generation, but potentially generations to come, especially if you're sitting it up inside an irrevocable life insurance trust and you're trying to have it go generation upon generation. There was another question. It says, in your illustrations, cash flow is only for 10 years. Does it mean the increase of cash value is paying the loan each following year? So,
Yeah.
Colin, you want to explain about that?
Yeah, I'll very quickly touch on that here. So typically we're showing cash flow for either 7 to 10 years. And this is really kind of a bank requirement and policy structuring is, funding this policy. So 7 and 10 is normally kind of the magic number of how long we're funding interest payments. After that, the bank is very comfortable letting you accrue interest. Therefore, you kind of have skin in the game from their standpoint, from our standpoint. We never want to offer this as free insurance. It's not. That's not what we're illustrating here, but it is something that you want to have some skin in the game. And that's typically why we structure it that way. After that, bank's going to let you accrue interest, and you're going to get further arbitrage on those dollars, the interest dollars that you would have ultimately had to pay.
And Colin, and to also emphasize that, can you go back to the illustration that shows the leverage life? And one of the key factors here is at year 19, if you take a look at that, there's a negative $16 million that's going on in a policy. that is actually repaying the loan at that point. It can be structured any way you want to structure it. We just happen to show you that we are repaying back the loan. And this is where life insurance differs than any other investment. And it's what's called a participating loan. That participating loans means when you take the money out of the policy, your account value still has the ability of growing like you never took the money out. And Colin, I don't know if you don't have the account value there to kind of show that, but if you were to see
No,
the
we do. That would be column 4.
column 4, okay. Yep. So you can see there with column 4 how we take the money out, we pay it back, and then it's still earning. That's the surrender value, but there's also should be an account value too that's still growing, assuming if we're using a participating loan. So you can definitely have that money grow in 2 different places. And that is one of the other key factors here is that we are paying back the loan, and that can be paid back differently. When we're having our annual meetings, if you want to start paying back the loan earlier, you're obviously more than welcome to do that. Right, Colin, if you want to talk a little bit more about the adjustments and the flexibility of being able to pay back the loan sooner than later.
Yeah. Yeah, no, I think it's good to expect that if you are going to be participating in this program, you should expect basically a 20-year time horizon conservatively until you are able to pay back that loan. But we have really good market performance, lower interest rate environments, certainly possible to pay back in 15. We've seen plenty of people do that. We've also seen people structure where they might want to wait till they're, year 25. Banks are going to loan this for a while. And if market conditions are favorable, maybe you continue to borrow. So you have a lot of flexibility with the banks. But when anyone goes into this, the expectation should be that you're going to have this loan for 20 years.
Perfect. And just to emphasize on that same question here. So really what's happening is we put in $1.25 million. That's the cash flow going in. We paid back the loan at year 19. And then that $474,000, that is cash flow that you're now taking out as a tax-free benefit. Again, it's a hypothetical. This is based off of market performance and whether it could be higher or it could be lower than that. But as you can see there, we've obviously taken out a significant amount of money out of that policy to include there's still a $6 million death benefit on that blue line if this individual lives until they're 88 years old. That death benefit, that trigger means that everything becomes tax-free. And going back to the question earlier, what's a deal gone bad? A deal gone bad would be is that you've taken out that $474,000 every single year, and then your family says, oh, we have $3 million of cash value left available. Let's go ahead and liquidate that. The moment you liquidate that and a death benefit does not pay out, then all of the taxes are then going to be owed on the capital gains because the IRS will come knocking at that point. So the way we've structured this is as long as $1 at a minimum pays out as a death benefit, that's how everything can be tax-free. But in this case, we're not just predicting $1. We're predicting, it's going to be several $1 million will still be given as a tax-free death benefit. And if it's structured in ILET, that comes outside the estate. And that's where we're with Jordan's team. And when we're working on it, since Jordan will be the one doing any type of estate planning opportunities that we need to have for the life insurance, we would make sure it's structured and doing exactly what your family wants it to do. Are there any other questions? Please either raise your hand. Those are great questions, by the way. Really, really appreciate that. And Benoit, hopefully we did answer your question there as far as with the cash value, paying it off there as well.
Great.
All right, perfect. Well, we want to thank everyone. We appreciate you could have been anywhere else today, but you spent it with us today. We're really excited about the follow-on individual meetings that we're going to have. Again, I know a few folks have already scheduled, so we really thank you for that. We're looking forward to those calls. And then in addition to that, we will be sending up follow-up emails. Again, if there is any issues that you have, and Ben, yes, to answer your question, we can stay on afterwards. But please, we don't want to spam you. Just let us know to remove you from a list because the last thing we want to do is keep sending you stuff. But for those that want to still learn more, we're going to be sending out additional follow-up emails over these next several weeks to help study and understand what that looks like. So again, we really appreciate everyone's time today. Colin, thanks for your time today. Hope you guys
Michael.
that are up north as well stay a little warmer. And of course, in Florida, it's been cold today. It was in the 30s in Florida, which is pretty crazy. But we're really looking forward, excited about our follow-on meetings. Please use us as a resource. If you need to, we'll be more than welcome to also, as we create your individual plans, to work with you and your financial advising or even your law firm and your estate planning attorneys, and we'll see how this will fit with them. So that will be part of our follow-on process when we start meeting with everybody.
Thanks all.
Yep.
Appreciate the time.
Hey, Colin and John, if you saw, there's a couple folks that want to stay on afterwards
Sure.
for some personal. Is there any other questions as we move forward? And again, thank you again for the time. I'm gonna go ahead and pause the recording there.